Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Market Regulators and Frameworks, a complete beginner's guide. Understanding market regulators and regulatory frameworks, key players, roles and challenges. Markets don't regulate themselves, and without oversight, chaos can follow. Market regulators ensure fair play, protect consumers, and maintain trust in financial systems. This video dives into who these regulators are, the rules they enforce, and how they shape stable, transparent markets. Whether you're an investor, a business owner, or simply curious, understanding these frameworks is key to navigating today's markets. What are market regulators? Market regulators are organizations or bodies responsible for overseeing financial markets. Their job is to maintain order, protect investors, and ensure markets operate fairly. Without them, financial systems could become chaotic, leading to fraud, instability, and a lack of trust. These regulators enforce rules that govern how markets function, making them essential for the financial system's health and transparency. Let's explore the different types of market regulators and their key roles. Types of market regulators. Market regulators come in several forms, each with a unique structure and purpose. They may operate under government authority, function as independent entities, or even regulate themselves. Here's a breakdown of the main types. Government agencies. These are regulatory bodies established and maintained by governments. Examples include the Securities and Exchange Commission, SEC in the United States, or the Financial Conduct Authority, FCA, in the UK. These agencies enforce laws, prosecute violations, and monitor day-to-day financial activities. Independent regulatory bodies. These organizations operate outside direct government control, but are still sanctioned by law. They monitor specific sectors or industries to ensure compliance. For instance, central banks like the Federal Reserve often play this type of role by regulating monetary policies and overseeing banking systems. Self-regulatory organizations, SROs. These are industry-led groups with the authority to create and enforce rules for their members. An example is the Financial Industry Regulatory Authority, FINRA, in the US. While they don't have the same power as government agencies, they play a critical role in maintaining ethical practices within industries. Each type of regulator plays a part in creating a system of checks and balances, ensuring accountability at every level of market operations. Key functions of market regulators. Market regulators are the backbone of financial stability. Their functions go beyond simply enforcing laws. They work to protect investors, deter fraud, and keep markets transparent. Here are their primary responsibilities. Enforcing laws and regulations. Regulators ensure market participants follow established rules. This includes monitoring trading activities, investigating misconduct, and imposing penalties when needed. Protecting investors. Safeguarding investors is a top priority. Regulators work to prevent scams, misinformation, and unfair practices that could harm individuals putting their money into markets. Ensuring market stability. Without stability, financial markets can't function effectively. Regulators monitor for risks like excessive volatility or systemic threats to prevent large-scale collapses. Promoting transparency. Clear and honest market practices build trust. Regulators require companies to disclose financial information, ensuring investors have the facts they need to make informed decisions. Encouraging fair competition. Regulators prevent monopolistic behaviors and ensure no one entity can dominate the market unfairly, fostering a level playing field for businesses and investors alike. By balancing these functions, regulators create an environment where markets can thrive while protecting the interests of all participants. Their actions might not always make headlines, but their impact is felt every day, in the stability and reliability of financial markets. Importance of regulatory frameworks. Regulatory frameworks are the foundation of well-functioning markets. They set the rules, define boundaries, and guide behavior to ensure fairness and stability. Without them, markets can become unpredictable, creating risks for investors, businesses, and society. Establishing trust in markets. Trust is the cornerstone of any market system. If investors doubt the fairness or transparency of a market, they'll hesitate to participate. Regulatory frameworks address this by setting clear rules and enforcing them consistently. Investor confidence, regular audits, disclosure requirements, and anti-fraud regulations reassure investors their money is protected. When people see accountability, they are more likely to invest. Business reliability. Companies also benefit. A trustworthy market encourages long-term investments and partnerships, which fuels growth. Think of it as a sturdy bridge. When people know it won't collapse, they're willing to cross it. Level playing field. Rules ensure everyone plays fair. Without them, larger players might exploit their power, driving smaller participants out of the market. Regulatory frameworks act as referees, keeping competition healthy. Would you trust a game without referees or rules? Markets work the same way. Without oversight, chaos replaces order. Regulations give stakeholders a reason to believe in the system. Mitigating financial risks. Markets are complex. Left unchecked, a single failure can trigger widespread issues. Regulatory frameworks are designed to minimize these risks and keep financial systems stable. Preventing market failure. Remember the 2008 financial crisis? Poorly regulated markets played a big role. Effective frameworks ensure lessons from the past aren't repeated. By monitoring activities like high-risk lending or unchecked speculation, regulators act as watchdogs to prevent systemic problems. Reducing volatility. Oversight helps manage sudden price swings that can destabilize economies. Regulations on trading practices like circuit breakers or limits on short selling provide guardrails to maintain order. Protecting consumers. Risk isn't just at a macro level. Individuals face dangers like fraud or predatory practices. Regulatory frameworks ensure that banks, brokers, and businesses meet ethical standards, shielding consumers from harm. To put it simply, these frameworks are like seatbelts in a car. You can drive without them, but the risks skyrocket. By managing uncertainties, regulatory systems help markets grow without putting everyone's future at risk. Major market regulators worldwide. Market regulators around the world play a critical role in ensuring the stability and fairness of financial markets. These organizations set the rules, enforce compliance, and protect investors, businesses, and economies from malpractice and instability. Below, we'll break down the functions of some of the most influential market regulators globally. Securities and Exchange Commission, SEC, USA. The Securities and Exchange Commission, SEC, is the main regulatory body for financial markets in the United States. Created in 1934 during the Great Depression, its primary mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. But how does it achieve these goals? Investor protection. The SEC requires companies to provide accurate, timely, and comprehensive financial statements. This prevents misinformation and fraud, ensuring investors have the facts needed to make informed decisions. Major regulations. Landmark rules like the Securities Act of 1933 and the Securities Exchange Act of 1934 fall under the SEC's jurisdiction. These laws govern everything from public offerings to insider trading. Monitoring financial markets. The SEC oversees stock exchanges, brokerage firms, and other participants to ensure compliance. It investigates potential violations and takes enforcement action when necessary. Why does the SEC matter? Without it, trust in U.S. financial markets would deteriorate. Its work ensures transparency, accountability, and investor confidence, fueling the engine of the American economy. Financial Conduct Authority, FCA, UK. In the UK, the Financial Conduct Authority, FCA, ensures financial markets serve consumers and businesses effectively. Established in 2013, the FCA regulates over 50,000 financial firms, from investment banks to small lenders. Its primary focus? Protecting consumers, ensuring market integrity, and promoting healthy competition. Consumer protection. The FCA acts as a watchdog against misleading advertisements, unethical lending practices, or failures to disclose risks. By doing so, it shields customers from harm. Maintaining market integrity. Firms are required to act transparently and fairly. This includes adhering to strict anti-money laundering rules and ethical business practices. Encouraging competition. By setting clear guidelines, the FCA ensures businesses face fair competition while reducing barriers for new entrants. This benefits both companies and end users. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.